Layoffs are coming, and you won't believe why. I'm your host, Steven Van Metre, and thanks for joining me today. And it seems just not long ago that employers were desperate to get employees at any cost, and soon they're going to be sending them pink slips. And you might be surprised to find out why. Let's kick the story off where we head over to Bloomberg, who headlines that the U.S. services gauge falls to a one-year low as orders soften. The ISM measure fell to 56.5 in February from 59.9, which is a great number a month earlier. And in fact, the index of employment has slumped to the lowest level since August 2020. The Institute for Supply Management's gauge of services fell 3.4 points to 56.5, below even the most pessimistic estimate in the Bloomberg survey of economists, according to data released today. Readings above 50 signal an expansion. And so what that means is the services sector is still growing, but the rate of growth is slowing down. So imagine you're in your car and there's a stoplight ahead and you start slowing down because it's red. You're still moving forward, but the rate of your growth, the rate of your movement is slowing. And that's a bad sign for the services sector because it's been expected to be booming and hiring tons of people. Let's keep going, because here you can see the gauge of the services sector in this graph or chart from Bloomberg. The activity stumbles to a one-year low, and you can see very clearly it's slowing down. And new orders, which are very critical in terms of a demand perspective, you want to see new orders rising, but even they're slowing too, showing that perhaps there may be a demand issue. Let's keep going. The group's index of new orders also showed the slowest growth in a year, while a measure of business activity, which parallels the ISM gauge of factory production, fell to the lowest level since May 2020. Moreover, an index of employment contracted, and that seems to be a really peculiar thing because, again, we've been hearing how all these services companies are so desperate for people, but all of a sudden, according to the ISM data, they're starting to let people go. And that doesn't make a lot of sense because what you would normally expect to see in an expansion is you want to see the manufacturing sector boom and then the services sector come following it. And not what we're seeing is the services sector has barely got off the ground. And now from an employment standpoint, we're seeing employers start to lay off. Let's keep going because here you can see the data on employment for the services PMI contracting at 48.5. Again, this should not be happening, telling us that there is something going on, either a supply, a demand, or perhaps both, compared to the factory sector, the manufacturing, which is expanding at a slower rate on employment. So it went from 54.5 to 52.9, meaning they're still hiring, just the pace of hiring is slowing rapidly. And what this big picture is, the economy is growing, but at a slower pace. And in the midst of high inflation, what does that tell us? Well, that we're seeing stagflation. Of course, we know what happens after stagflation. Well, that's deflation. Let's keep going because respondents continue to be impacted by supply chain disruptions. So they're blaming all of this on the supply chain, capacity constraints, inflation, and logistical challenges and labor shortages. Well, that doesn't make sense, Anthony, because as the chair of ISM Services Business Committee, because there's labor shortages, we shouldn't see a contraction. These conditions have affected the ability of panelist businesses to meet demand, leading to a cooling in business activity and economic growth. But perhaps it's something, well, completely different. Perhaps there's a demand component here that people are just completely missing. And here you can see on the real disposable personal income down 9.5% on a year-over-year basis. That means people's real or inflation-adjusted disposable personal income is down almost 10% from where it was a year ago. And as you can see in this historic chart, this has never happened before. So it starts to make sense of where people will start cutting their spending? Well, the services sector. So perhaps what the services sector may be claiming, they have a supply problem, they also have a demand issue. Of course, that demand issue will eventually lead to more unemployment. But that's not the big story here. That's not the catalyst. Let's keep going on because the overall ISM measure has fallen 3 straight months and is down almost 12 points from a serious peak in November before pickup in coronavirus infection stifled activity. And you know what typically happens within 3 months of a peak in the ISM? That's right. Stock prices peak. You've got it. And that explains why the equity markets are heading lower despite people being mega bullish on stocks when they need to be mega bullish on the ISM going back up. Such supply and demand imbalances are also driving inflation. A measure of prices paid for materials edged up to 83.1, near the highest in record. Commodity prices continue to rise, triggered by Russia's invasion of Ukraine that threatens to fuel the inflation further. And that's right, we're seeing prices paid numbers stay elevated, and they're likely to stay up due to crude oil. But if you're at all concerned about a bear market and what a falling ISM could mean to your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link in the corner in the description below. You'll be glad you did. Now, let's get into a little bit of good news. Before I give you the catalyst of what's going to trigger this, I want to give you a little bit of good news because there is some good news out there. And I want you to understand that U.S. jobless claims fell to 215,000, remaining near historic lows as employers are holding on to workers. So you might be asking, well, where's this catalyst going to come from? And well, let's just get to the good news first, and then I want to show you exactly where this is coming from. And we can see the initial jobless claims, a proxy for layoffs, fell by 18,000. So this is good news, and it's down to revised 233,000 for the week ending February for the week before, according to the Labor Department today. The 4-week moving average fell to 230,500. And again, this is great news because when you're in the low 200,000s, it's telling you the labor market's strong. And even more validation is continuing claims, a proxy for the total number of people on unemployment. Rolls through regular state programs ticked up by 2,000 to 1.476 million for the week ending February 19th. The 4-week moving average of continuing claims that week fell to 1.539500, the lowest since April 1970. And so this is great news because what it's telling us, and you're kind of wondering, well, what could this catalyst be? Because there's nothing but good news in that part, right? People aren't losing their jobs as much, and those that are, the data is telling us they're able to get back into the workforce. But that's not how it's going to go. Employers are not in a rush to reduce their workforces, according to Mark Hamrick, senior economist analyst for Bankrate. Well, Mark, I got news for you. They're going to be, because J.P. Morgan says that $185 oil is in view if Russian supply hit persists. And why does that have anything to do with the unemployment rate? Because you might think that perhaps high oil prices would be good because oil companies would go out and hire more people to get more of that stuff out of the ground. And that money being spent in labor and equipment and all that would filter through the broad economy. And if you think that, then that would be very smart because it makes a lot of sense, except it actually doesn't work that way. Let's check out what happens when oil prices go up. What happens to unemployment claims? And here you can see here I've got crude oil prices, West Texas Intermediate, overlaid against initial claims. And I've had to cut off the recent history just so you can see the relationship. But note how crude prices rise here in blue, and you can see already build an increase in initial claims. How about here in the late 90s, crude oil is rising, claims are going down, then all of a sudden claims start to go up. And you see crude rising here in the kind of mid 2000s, and that sends initial claims up. And what is that telling us is that financial conditions are tightening and that consumers can't afford higher energy prices, and small businesses, which are critical, they also can't afford those higher prices because they can't pass them on to the customers because the customers don't have the money to buy those higher price goods and services because they're being impacted by high energy prices. So when we look forward, and I've had to kind of, again, adjust the graph here a little bit so we can see it, as energy prices head higher, as crude prices head higher, the belief now is that unemployment claims are going to stay low, but in reality, they're going to go higher because high crude prices. Do you know how many times when we see massive spikes in crude prices that we see a recession? 100% of the time. I know. Can you believe that? It's crazy, but that's the catalyst. So next, we're going to see as unemployment claims start to rise. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided educational information. It's not intended to provide investment advice. You don't have to be construed as recognition or solicitation by selling security, financial instrument, or participate in particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity, business expressed in this video that do not affect the view of outlets from advising or Steven Van Metre Financial.